If you have been in crypto for a while, you know that everybody is saying you should dollar cost average into the market. You should be buying a little bit of your favorite asset, let's say Bitcoin, a little bit, say every week or every month. You simply just ride out those waves, right? You're buying. You wait until the price goes up a lot, and then potentially you might be rebalancing your portfolio depending on your risk tolerance. You might take some profits. Once we go up, you might be dollar cost averaging out on the way up. But in general, right, if you want to get exposure, you don't just throw in all your capital at once, you dollar cost average in. And fundamentally, I agree with this because this helps to diversify in different ways, right? You're not just diversifying now across different asset classes, as in you don't just have crypto and maybe other asset classes like stocks or property, but you're also diversifying across time, across volatility, because nobody can say for sure where Bitcoin will go, right? Especially when we go up in the price and then we are high. Then we could go either way, right? We're not dirt cheap anymore. We could simply just continue rising because the momentum is positive, but also in case there's not enough people that jump on the rally, we could also retrace again. So it's very unclear once we are already in the rally where the price will go. And so dollar cost averaging, if you don't have yet enough exposure, and diversifying over time, diversifying over the volatility does make some sense. Now, there is a second way though to diversify. So the idea is that you're dollar cost averaging in simply because over the long term you believe in the asset, right? Over the long term you believe that Bitcoin will be higher, say in 10 years. And so you don't really think too much about timing this right. You simply believe that you can ride this wave over a very long time and you want to still be able to take advantage of potential price drops. Right? That's why you dollar cost average in. You can't dollar cost average into, say, Dogecoin, because you don't know if Dogecoin will be higher 10 years from now compared to today. Because you don't know that, you can't just, with a lot of conviction, buy those bottoms when we go down. So dollar cost averaging does take conviction that whatever you're buying will be around in 10 years and will be potentially also more valuable in 10 years, right? When you're buying a house, you're also dollar cost averaging in it to a degree. You're locking in the price today, but still you're contributing to that equity every single month. You're paying off the house. So you have regular cash flows out of your income that contribute to the asset. Now there's a second reason though why you might be dollar cost averaging in. It's not just for the assets that you believe in will be higher in 10 years from now. You can actually use dollar cost averaging also for trading. And the way to do this is you think about what would be your ideal allocation to a position. So let's say you do want to trade that Dogecoin. And let's say you believe that overall the medium-term trend is fine. You don't necessarily believe that in 5 years we will be higher, but you're simply just trading, right? So you believe at some point we're probably going to be higher for whatever reason that is, right? Maybe you think an influencer will talk about it. Maybe you think the tokenomics are great. Maybe you think the whales are currently buying in, or a centralized exchange listing will happen. Whatever your thesis is, you believe at some point in time there will be a spike in the price. For premium, for example, we look at what are other influencers currently buying and what might they make a video about. Because when they make a video about a certain small altcoin, the price tends to shoot up. So what we tend to do is, when we believe that an influencer is going to publish a video on a certain token, and at the same time we know that the token is super volatile right now because it's so small, what you can do is, instead of putting in your complete position from day one, you can dollar cost average into the position. So you're not buying the position in order to sell it very late because you are fundamentally convinced in this asset. You're just, again, diversifying across volatility. You might be buying a bit now because maybe we just shot up a little bit. But then if you see the retracement and we haven't yet seen the video, you might be buying again. If it then continues to go down, you might be buying again. Right? So you want to allocate according to your overall risk profile, of course. You don't want to end up your whole portfolio being allocated to this one little micro cap. But you can buy the dip on a poor asset if you have the thesis that that asset will go up due to a specific event that's in the future. So that can be a video release, that can be other things as well. So when trading, don't necessarily always think of where's my one entry, where is my one exit. You can also somewhat diversify in the entry especially. For the exit, I tend to sell directly because normally we are not at these elevated prices for a long time. We tend to be at low prices for a long time, but the elevated prices normally come in hype waves and then the whales take very quickly profit. So you want to sell fast on those short-term trades, but you can afford to potentially buy slowly. You can potentially buy several times. And that does make sense the more volatile an altcoin is. Because let's say you buy a small micro cap and then it goes down, say 30% because it's such a small cap, right? Somebody took, 10, 20K profit. Suddenly the price is down 20, 30%. What do you do when you know at the same time that an influencer is very likely going to promote this coin in, say, 2 or 3 days? You could just keep on holding and then maybe exit at plus minus 0, or you could be buying the dip. And this is, I think, what makes the difference between the seasoned traders and the not so seasoned traders. You want to be allocated with your first purchase, of course, to a degree that you still be fine in case the price doesn't go down, but you should still have enough firepower left that in case you have to buy a second or a third time, that you can do this without messing up your overall portfolio balance. So there's 2 reasons for dollar cost averaging. One, simply that you're long-term bullish on something. You don't really have to look at the prices every day. You can just buy and forget about it. Or the second reason is simply just to diversify your entry point in the hopes that then this future event that you speculate on happens. If that doesn't happen, right? So in this example, if the influencer doesn't make the video and the influencer bought, maybe you track the wallet, you know the influencer holds it, but he didn't do a video for like 1 week, they can simply just exit. Right? They simply don't look at the asset anymore. So you want to manage your risk to a degree, right? You don't want to turn a short-term trade into a long-term investment just because your initial thesis didn't work out. That's a very common mistake a lot of people do. But you can afford to double and triple down and then see if your thesis gets validated. If it does, very nice. Then you simply just then you simply just sell at the top very, very quickly. If it doesn't, then you sell simply just after a while and the video has been released and you're taking the potential small loss, right? Because in the end, especially in those smaller caps, the volatility is very, very random, right? It's very erratic and very random, and it's very, very hard to time this in any form. Feel free to subscribe in case you're new here. Feel free to also give this a like in case you want to help this channel grow. And of course, see you next time. Cheers.